The markets are normal. The political environment's not normal.
Correct. But the attribution to the fall in the market.
Well, look,
The market goes down.
and the market might have gone down if there were no tariffs.
That's right.
And so when the market goes down, people find something to blame. That's why the markets are going down. And I think to put things in, I had dinner last night with my parents and my mom and stepdad and one of my sisters. My sister's 65, maybe, still working. And she's a little concerned about the market. So I'm talking to her for a bit. And like, I've been her brother for forever, right?
Yeah.
And she's heard all this stuff from me. And she's got roughly half her portfolio is out of the markets and fixed income and out of the stock market at all. But she's still freaked out about the markets. And she's not the only one. Like, this is very common that people are concerned. And if you kind of step back for a moment, first of all, if you go back 75 years, there are declines throughout, even in years when there's positive returns, there's usually periods like this when there's a 10% or more correction. The average intra-year decline, so during the year, intra-year, is just over 14%. So on any typical year,
okay,
you can expect a 14% decline in stock prices.
at some point,
Right?
But
Not every year, obviously.
Yeah.
Some years worse, some years not so bad.
And the market declines like this on average, every 27 months? Is that?
There's a correction, 10% correction, historically every 9 months, and a bear market every almost 4 years.
Okay.
Bear market being a 20% decline.
So the attribution is different this time. It's always different.
Yeah, because there's different factors, different circumstances.
Correct. But the market decline is not unusual. It's a risk premium. That's why you get higher rates of returns out of equity portfolios over time.
Because they swing in prices.
Which is, there's risk in there. And if you have a broadly diversified portfolio, all right, which is, I talk about this investment thesis that you should have, right? And the reason I actually have to remind myself.
I do too.
Right?
Look, we don't like it when our portfolios go down any more than anybody, right?
Yes, especially
Not only we have a fiduciary responsibility to our clients, but we're also we're investors ourselves.
Yes, and so this article, Wall Street Journal, the days of set and forget investing just ended for many Americans.
What does that mean?
It means like,
what are you supposed to do now then?
I don't know. Well, it talked about how people
you should never really set and forget.
Well,
you should have a plan,
a rebalance. You should have a rebalance in your portfolio so that you stick to your investment thesis, right? So people let their portfolios run, right? And so think about if you'd let your portfolio run over the last 2 years. What was the returns last year?
The last 2 years, the S&P, if you invested January 1st of 2023, by the end of December 31st, 2024, you had a 53% gain.
Which means
massive.
Which means if you had a portfolio of 50% stocks and 50% bonds, by the end of that period, your portfolio would probably look like 70%
or whatever,
equity,
65, whatever the percentage,
whatever the number is, and the rest is in fixed income. So your portfolio has progressively gotten more risky as the markets go up. And if your investment thesis is, which I advocate should look like pension plans, which is they trim the gains and they bolster the losses so that they're keeping a relatively constant equity to fixed income.
What happens often if you were to this set and forget, you end up getting overweighted in stocks as the years go on. And you may be comfortable with that, but most people, what happens is nobody wants to sell their winners.
That's right.
Things go up, they're like, whoa, it's doing so well. Like, why would I want to get rid of this?
This article went on to say how people are actually moving money out of the U.S. markets into some European markets, the DAX, the German market, and some European, because they're doing so well. And I thought, this article has got some revealing things in it One being that,
Maybe you should have a globally diversified portfolio through all market cycles.
right, which is what we talk about all the time, why the average investor underperforms the index in which they're actually invested in because they do it at the wrong time. Right? So if a European market was down and the U.S. market was up,
nobody wants to sell. Nobody, Pat. I have not had one person in the last couple of years saying, "Hey, Scott, I've noticed the U.S. market has completely outperformed the rest of the globe. Why don't we trim our U.S. stocks and buy more global?"
Yes, I had it happen to me
and
once in my career.
Instead, you're fighting the opposite. Why do we have global in our portfolio?
This
why do
thing's
we have
losing money
of anything outside of the United States?
Which is why rebalancing a portfolio is so important.
And with new technologies that can rebalance. I mean, quickly and easily without the transaction costs that there used to be. Just a couple of years ago, there was trading costs on everything.
Yeah, friction.
Selling a stock, now they're virtually free. For example, direct indexing, when it's turbulent times like that, they really take advantage of harvesting losses.
That's right.
It could be very powerful, help the overall portfolio.
Well, this article, when I read it, I thought, well, there's 4 or 5 things we can learn from this. One being that the political environment should not be shaping. Look, I know someone that when Joe Biden was elected president, they took all of their money out of the stock market and didn't go back in until Donald Trump was elected again.
Oopsies.
I'm like, what? We're not managing the portfolio.
Obviously.
I'm like, what? But then I know people that when Trump was elected the first time, they took all their money out.
That's right.
Like, you don't have an investment thesis. You are driving your portfolios purely emotional.
And not every, the vast majority of any article you look at, all that clickbait online, it's not designed to make you a better investor.
That's correct.
It's designed to get you to read the article and hopefully click on an advertisement.
That's what their job is.
That's 100% of their business model.
That's what their job is.
And don't forget otherwise. You read those articles, don't forget, wait a minute, are they here to really help me?
No, they're to sell you something.